You're watching ESC News. Thank you for joining us. Let's have a look at today's finance. The CSX Index is currently at 505.03 points, down 1.24 points or 0.24%. The daily exchange rate is 4,061 real to the US dollars. And now a look at what else is happening in finance around the world.
Asian shares advanced on Tuesday led up to jump of technology majors as hopes grow as easing China's unprecedented regulatory crackdown on once-freewheeling tech sector. European markets were set in a higher open with the pan-region and Euro Stoxx 50 futures up 0.85%, German DAX futures raising 0.87%, and FTSE futures gaining 0.45%. US Stoxx futures and S&P 500 E-minis were up 0.42%. MSCI's broadcast index of Asian Pacific shares outside Japan gained 1.5% on Tuesday, but the index is still down 6.4% so far this month. US stocks ended with previous sessions with the mild losses. In Tokyo, the Nikkei rose 0.33% in the afternoon trade, while Australia, the SP/ASX 200 index gained 0.25%. Mainland China SCI 300 index gained 0.95%, while Hong Kong's Hang Seng index was 2.35% higher. As tech firms listed in the city jumped more than 4% on hopes of Beijing's crackdown on the sector being relaxed. In afternoon Asian trade, the yield of benchmark 10-year Treasury notes rose to 2.9203% compared to US close of 2.879% on Monday. The 2-year yield rose, which traders' expectations of higher Fed fund rates touched 2.6112% compared to US close of 2.568%. The US dollar index, which tracks the greenback against the basket of currencies, was flat in Asia trade to be at 104.15. The dollar rose 0.17% against the yen to 129.38, getting closer to its high of 131.34%. The European single currency was up 0.1% on the day, $1.044 having at least 0.96 in the month. US crude dipped 0.39% to $113.76 a barrel. Brent crude fell 113.88 cents per barrel. Gold was slightly higher. Spot gold was traded at $1,824.44 per ounce. The SP 500 ended lower on Monday, with Tulsa and other growth stocks losing ground after a downbeat Chinese economic data added worries about the global showdown of rising interest rates. The SP 500 Energy Index railed at 2014 intra-high. It closed at 2.6%, making it the strongest performer among the 11 sector indexes. Investors question whether a strong day on Wall Street last Friday might signal the end of the recent sell-off and has left the SP 500 down 16% from the record highest close in January. Many of Wall Street's mega-cap growth stocks are lower, with Amazon and Google owner Alphabet losing more than 1% and weighing on SP 500 Nasdaq. Twitter fell more than 8% after Bloomberg reported Elon Musk said the deal by social media company at a lower price it has previously agreed to $44 billion was not out of the question. Tesla, which Musk leads, fell almost 6%. The SP 500 healthcare sector index rose 0.7%, lifted up by 2.7% jump, and Eli Lilly & Co. after the drug maker won US approval tripletase. Oil prices inched lower as EU Russians on oil-based stands. Oil prices inched lower on Tuesday as Hungary registered a European Union push for the ban of Russian oil imports, a move that would tighten global supply, which investors taking profits on a recent rally. Brent crude futures fell 11 cents or 0.1 to 114.13 cents a barrel on 6 o'clock this morning. As US West Texas immediate crude futures slid 22 cents or 0.2% at 113.98 cents a barrel, both benchmarks gained more than 2% on Monday following a 4% jump on Friday. McDonald's Corp said on Monday, 16th of May, it would sell all its 847 restaurants in Russia after more than 30 years, making it one of the biggest global brands to exit since the Russian-Ukraine conflict began. The company expects to record a non-cash charge of $1.2 billion to $1.4 billion following the sale. Last year, it generated 9% or $2 billion in revenue from the Russia and Ukraine. Ever since McDonald's shut its stores in Russia, it has been losing roughly $55 million a month to pay staff, landlords and suppliers for the restaurants in Ukraine and Russia, company executive has said. That's all the latest news and finance. Tune in tomorrow for more.